It's all about the risk curve. All assets are priced according to a risk curve. The least risky asset is Bitcoin. The most risky is a meme coin. So what happens is when Bitcoin goes down and liquidity is withdrawn, the most risky assets fall. What happened after liquidity was withdrawn from the US because of the rebuilding of the TGA and the government shutdown? The riskiest asset, Bitcoin fell. It's always the same process. So if Bitcoin falls 30%, ETH's going to fall 40, Solana's going to fall 65, Sui's going to fall 70, and meme coins are going to fall 95. That's normal. It's just a normal risk curve. And so it's not about a lack of demand, it's about a lack of risk taking due to liquidity conditions and disposable income. It's an amazing chart of NASDAQ versus global liquidity. I mean, it's one for one. It's one for one, and it shows where global liquidity is going because it leads. So for asset prices, if liquidity is increasing, they all go up.
To understand crypto markets properly, Raoul Pal argues that we must abandon surface-level narratives and instead view the entire ecosystem through a single unifying framework, the global risk curve. Every asset in the world, whether equities, bonds, commodities, or digital assets, is priced according to its position on that curve. The difference with crypto is not that it behaves differently, it is that it behaves more purely. At one end of the risk spectrum sits Bitcoin, the least risky asset in the crypto universe. At the far end sit meme coins and highly speculative tokens, whose value is almost entirely dependent on excess liquidity and investor risk appetite. Everything else exists somewhere in between. When liquidity expands, capital moves outward along the curve. When liquidity contracts, it snaps back violently towards safety. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
It's all about the risk curve. All assets are priced according to a risk curve. The least risky asset is Bitcoin. The most risky is a meme coin. So what happens is when Bitcoin goes down and liquidity is withdrawn, the most risky assets fall. What happened after liquidity was withdrawn from the US because of the rebuilding of the TGA and the government shutdown? The riskiest asset, Bitcoin fell. NASDAQ didn't really. So it always happens the same way. It happens in the credit markets with treasuries and emerging market junk bonds. It's always the same process. So if Bitcoin falls 30%, ETH's going to fall 40, Solana's going to fall 65, Sui's going to fall 70, and meme coins are going to fall 95. That's normal. It's just a normal risk curve. And so it's not about a lack of demand, it's about a lack of risk taking due to liquidity conditions and disposable income. So then let's play forward to what we talked about at the very beginning. What do we expect this year? The business cycle to rise. What does the business cycle do? It gives us all more money in our pockets, more confidence in the economy, more risk taking. So when you put the ETH Bitcoin cross against the ISM, it's the same thing. It's all the same thing. It's all the business cycle. And so when the business cycle picks up, people go out the risk curve. So what alts you own? Okay, that's the hard thing. That has always been the hard thing in alts, right? It's not, people think alt season and think it's your God-given right that your bag will go up, but that's not how it works. Particularly the more and more tokens there are, a whole bunch of this stuff is uninvestable, will never get investment. So you have to ask yourself, is there provable network adoption and attention? And those things give you a higher quality trade than, hey, XYZ thing is down 95%, it looks cheap. Is that going to work? To a certain extent, yes, because the liquidity flows through the market making, and what happens is it tends to readjust prices on a relative basis. But the best thing is just to think carefully about what you're buying. If you want to do alt season sensibly, you're pretty easy to buy Ethereum and Solana. It's not that difficult. Maybe you put 50% of your capital in Solana and ETH. Then you've got 50%, you can go a bit further out the risk curve. So let's say some of the layer ones that are interesting, and maybe some applications layers. And then a couple of your pet projects that might do really well in AI or whatever. Right? That'll give you a relatively balanced portfolio where you can't fuck it up. Because if not, everybody fucks it up. It's an amazing chart of NASDAQ versus global liquidity. I mean, it's one for one. It's one for one. And it shows where global liquidity is going because it leads. So for asset prices, if liquidity is increasing, they all go up.
The next phase of crypto's evolution may not come from tokens alone, but from crypto-native corporations, treasury-backed entities, Decentralized asset trusts and operating companies are beginning to resemble hybrid vehicles, part equity, part crypto exposure. Some will fail, others will trade at persistent discounts to net asset value. But a subset will evolve into true operating businesses, deploying capital into venture investments, ecosystem development, lending, and infrastructure.
So if you think of what happened in the equity flash crash in 2014, we saw something very similar, right? Big multi-billion-dollar companies down 80% in a minute, 3 minutes. A lot of those trades got cancelled by the exchange because there's regulatory bodies, there's all sorts of... In crypto, we don't have that. So what happened was the liquidation cascade starts, there's forced deleveraging, but then the Binance API went down for the market makers. That couldn't have been a worst possible outcome. Now, let's assume it just happened because everything was breaking at the time. No market maker was able to bid in these liquidation cascades. So they became much more exacerbated. So who then bought, because we couldn't as retail get onto the platforms either. We were pretty much shut out of everything. There was this whole discrepancy between Coinbase and Binance. So who stepped in to provide the liquidity? Sure, the market makers came back. They got some, but we know they got slightly impaired because everything shut down, they couldn't trade. And my guess is the exchanges, because it happened on a few Asian exchanges as well, probably had to use their balance sheet to step in to provide liquidity. Because if they hadn't, it would have broken everything. Everything would have kind of gone to zero. So it would make sense to me that that occurred. And nothing nefarious. It's like, what the f do? We need to do something about this. We need to provide liquidity. So you use your balance sheet and you buy whatever's being liquidated. So then you've bought a whole bunch of altcoins, Bitcoin, everything. I don't know how much, let's say the number's 10 billion. Who the hell knows, right? Now you need to get rid of that off your inventory because you can't hold it on your balance sheet. They're not a hedge fund. So then you've got to work it out. So how do you work it out? Well, you kind of do it like you did in program trading and equities, is you work it over time, which would explain why we got these weird, as soon as the US opened, 10 o'clock, the most liquid time of all of crypto, the slam. Because somebody uses an algorithm, what's the most liquidity? That's that time of day. How much do we need to get out of? Let's say it's, X, 200 million a day, whatever the number is, and you get the slam. And that had the footprint of that. We didn't see any other evidence on chain of others doing stuff. So it kind of made sense to me. And I think that created the liquidity gap the other markets didn't show. The other issue is there's a huge amount of call selling by long-term holders. And all of these Bitcoin yield products, they're all based on call selling, really. There's some lending, some call selling. MicroStrategies cause a lot of call selling. So you've got that natural dampening of the market of people kind of extracting a bit of yield out of their long-term holdings. I think most of us would assume that that is around the 100,000 strike, that people have been doing that. And we kind of need to clear that out of the way so there's less delta hedging when it happens. I think the DApp market is probably cheap if you think crypto's going up. I think we've passed the first round of risks. We saw some people selling out of tokens, buying back their shares. I think in a full bear market, we might see more, but I also think we will see kind of corporate raiders buying the DATs, stripping the assets, if they're trading at a discount. I'm less worried than I was about the DATs overall. I think Michael Saylor's cleaned up his balance sheet as well by raising the fiat to take that risk off, using the new share structure that he's built. I think that helps. Many of these will just wither on the vine. They just won't do anything. And they'll trade at discounts to NAV until the discount's big enough to break up the company. That's kind of how it feels like to me. And we've seen these with closed-end funds. Other ones, like Tom Lee is doing, and others are actually trying to build value. He's got the VC part of his and public market investing part of his portfolio. That gives some convexity to the upside. So it's not just looking like an ETF that trades at a premium and you take some cash out and stick it into the underlying. I think we'll see more of that. I think we'll see more operating company DATs that are trying to be ecosystem building the ecosystem out. So whether it's Solana, whether it's Sui, whether it's Avalanche, whether any of these ones that've got DATs, we could probably see them having VC, providing liquidity for lending, doing all things to grow the ecosystem, and that will grow the NAV per share. I think it depends. If they look too much like a closed-end funds, they're not really part of MSCI. If they look like a company that can grow its earnings and stuff like that, at the simplest level for me, then they should be included. So it really depends what they do and how they operate, I think. So I think, some caution in it. I get it, because equity investors, MSCI want, companies with earnings doing different stuff. And if you're just a holdco that holds one asset, you look more like a ETF or a trust. And last time I checked, the SPY ETF is not in MSCI. It tends to rotate anyway. And I don't like the narrative trade. It's too hard. It's too hard because capital is super fast in crypto. And by the time you hear about the narrative trade, everyone's moving on to the next one. So I'm very cautious of following narratives. My basic thesis is, will we use more block space in the future? What kind of block space do we need? And then even the applications layer is difficult to do. Hyperliquid now might seem the best thing in the world. Where does it stand in 3 years' time? I don't know. It feels more difficult to me than saying, will a layer one that is quality and has proven itself end up with more usage over time? I try and avoid all of the narrative stuff and just really zoom out and say what is likely to survive. So let's talk about BitTensor, which I don't have an investment in, although I keep looking at it. There is some traction within it of what's happening. People are using it. The narrative feels right. It feels directionally right. Is it going to be the one? I have no idea. It's not. These aren't easy. Zcash, another great one. Privacy. It's a very clear, clean, memetic understanding. It probably does decently well, and other privacy solutions. But then we'll see other blockchains introducing privacy solutions of different ways. So maybe it becomes less of an issue. But also, those of us who have been around crypto long enough, I'm not sure I want to fight with the bloody governments all over again. Is the finance sector going to use Ethereum in its various short forms? Most likely. Will they use Solana as well? Yes, probably. And then people get down but the layer twos and blah, blah, blah. You have no idea how big finance is. The DTCC clears $4 quadrillion of trades a year. Stick that onto a layer two, it's going to create enough demand for the layer one to go up too.
One macro indicator you check first every single day.
The dollar.
Okay, drives with liquidity. Got it. Most misunderstood asset class right now.
I actually still think crypto is really misunderstood. Just how even people in the space are just walking away. We can't have nice things. The cycle. I think there's a lack of understanding, analysis, and patience. That is a huge disconnect right now. I've never seen anything like it in still a bull market economic cycle. It's weird.
One narrative, be it crypto or TradFi, that you think is overstated, overrated.
I don't know. We're getting to that point in silver. I get it. Silver's used for a lot of things. There is some silver substitution, but the speculators now own quite a lot of silver. And if they sell out, that supplies a lot of silver for demand. So you kind of fulfill demand via the speculators selling out. So these things don't go on forever, which is why these commodity cycles are quite brutal. So I think the silver trade has overextended. Can it go further? Yes, but I just, it's not going to go up for infinity. By all accounts, this is when all of the debt rolling has to be done, all of the interest payments have to be made, all of the forward-looking liquidity, and we've seen the moves in the dollar, we've seen the moves in gold. I'd be f***ing staggered if it doesn't happen. That's the only way I could look at it. I'd be staggered. Can I be wrong? Obviously, but I'd be really, really surprised. The banana zone will accelerate later in the year because we've still got to digest these prices, move up, get through that 100,000 level, bit more digestion, and then finally you can start accelerating.
Raoul Pal's framework strips crypto of mysticism and replaces it with macro clarity. Crypto is not broken. It is not misunderstood because it is irrational. It is misunderstood because it obeys global liquidity more cleanly than any other asset class. Those who survive this phase will not be the ones chasing narratives or bottom fishing every collapse. They will be the ones who understand the risk curve, respect liquidity, and position themselves for the inevitable expansion ahead.